A note on this episode, we had some recording difficulties in the beginning, so the introduction did not get recorded, so I'm recording this after the fact. Today's video that you're going to get into is a panel / fireside discussion chat. We have Allen Johnson from Letter Capital and Marc Visent from Knowify, and Marc really tells a story about all the different funding options he had and different ways he acquired capital with Knowify, but then also his previous startup that he was also involved in. And Allen actually comes on and talks about all the options developers have with part of the $15 million QuickBooks Developers Fund that is available through Letter Capital. So please enjoy. It's really, really great. Marc is really open and honest about his journey, and you guys should enjoy it. And I'll stitch these together now. Thanks. Perfect. Got it. So Marc, obviously you're a developer, you have an app, you're on apps.com. I remember meeting you almost 3 years ago when you just had it was like a lead capture website, basically. It wasn't even a product yet. And I've watched your app really, really evolve from I remember the first conversation, you're like, our app's gonna do everything. And it's kind of gotten really focused, right, over time. And now you're just like, hey, we're for contractors. Like, this is what our app does. So I've watched your journey on apps.com, but I also don't know a lot about your backend journey. Like, how'd you even start Knowify or any of those types of things? So I'd love to hear kind of your why did you start Knowify? How did you start Knowify? Kind of that story a little bit.
So, I mean, you're exactly right. I mean, it actually happened like 3 years ago, right? That actually 3 years ago is when we started on apps.com. We started going to Intuit events, and we discovered the market and what were our options there. But a couple of years before that, and that's sort of like the classic story of many startups, we started doing something different, right? We were targeting a different industry with a different product. We wanted to help professional services firms, like engineers, architects, interior designers, when they're in this growth stage. They go from being a lawyer to hiring other lawyers, and then all the complexity that this involves in the office. We were super excited. We were building something great for them, and we hit the market, and we realized that they were not that excited. However, many contractors and small construction companies started to reach out saying, hey, I wish this was for construction. We don't have anything. We run our business on paper. This is a disaster. I mean, help us out. And you know what? Exactly 3 years ago, when I met you in QuickBooks Connect, we changed the name to Knowify for Contractors. And we started actually helping contractors grow, and especially helping contractors at what they struggle the most, which is the office work. And since then, it's been a great journey for us.
Cool. And now, so obviously you went from that one website. How big are you today? You have 500 employees now. Where are you now?
No, it's the opposite. We've always tried to keep it super lean, right? And we have 8 employees. We had 7 until actually Letter Capital, lend us some money. So we have now 8 employees. We have more than 600 construction companies on the platform. We are in the US, in Canada, UK, and Australia. And it's sort of the story of the stealth startup. We try to keep it simple. We try to keep it small. We try to be super capital efficient. And we'll talk about more this later, but that's one of the reasons we were super excited about Letter Capital.
Got it. So now you've talked about Letter Capital a couple of times. I was going to actually ask Allen to explain Letter Capital, a little overview, down the road in this, but I think you've kind of set the table. So Allen, do you want to kind of take a minute and just kind of explain Letter Capital and what you do, or where do you fit in the capital and funding space?
Yeah, absolutely. Yeah, thank you, David. Yeah, so Letter Capital was founded in 2012, focusing in on funding early stage tech companies. We want to fill the void that really exists between debt offerings, as well as not having to pursue only equity options. So we understand that entrepreneurs' time and effort is extremely valuable, and so we've created a fundraising path that is very efficient, expedient, and as well as doesn't require dilution on the part of the entrepreneur. We utilize the funding vehicle known as revenue-based financing to provide early stage growth capital. And so with it, the entrepreneurs' payments fluctuate over time, but some of the highlights of it are there's no equity dilution, we have no board representation, we have no financial covenants, and no personal guarantees. So it's very focused on the entrepreneur and providing them capital at the early stages.
Got it. Cool, thank you. I know some of you are kind of still streaming in. A few of you came in late. Just a reminder, we're doing a panel discussion today, and I would love if you, as attendees, if you have any questions, to put them in the Q&A panel, and I will ask those to our panel today for sure. So Marc, as you're growing, right? Obviously, you've stayed very, very lean, as you said. What have been some of the financial challenges? I mean, did you get your money from your rich aunt first? Like, what's been your financial journey along this story?
Well, no, if I started with friends and family, we had very good friends. So we were able actually to raise a decent amount of money. So it was kind of like a large seed, you want to see it in this way. And we were able to grow, to build the platform, to hit the market, to get all these companies on board. And then obviously, you have the classic question, okay, what's next for us, right? We stay the same way, we just like try to grow organically, sort of like slowly, or we feel that we can go a little bit faster. And it was actually when we saw there was the option of going faster that, classic, you start like talking to VCs, talking to more like institutional investors, and seeing what the options are out there. And, once we saw these options and then we discovered lighter capital, we had to make a decision. And for us, it was actually a very easy decision. It was probably easier for us because we are not the classical startup that will go there and burn, like hundreds of thousands of dollars a month. We are in a different journey. We are in a different, sort of like, we have a different like approach to the market. We try to grow as fast as the market can take it. And the construction industry is not a super sophisticated industry, right? So it will take a certain growth. And for that, we don't need tens of millions of dollars. We need actually less cash, and we always try to be very efficient. So if we want to go to a few trade shows, if we want to hire 2 employees, and if we want to, do like a couple of growth initiatives, we do not have to give up 30% of our equity. We don't want to dilute everyone here. We want, like the team to preserve the ownership of the company. And it was a great option to go with lighter capital. If you think about this, if I ask, classic thing, I would ask my dad, right? Dad, we had to raise money, and what would you do? And he was like, well, go to the bank. I go to a bank, ask them for money, they're gonna lend you money. He's like, well, that might not work that well for me in the US, but that's actually a right approach. How do you raise, you would go to a bank, and a bank doesn't have the knowledge actually to lend money probably to a SaaS, a subscription-based company like ours. But lighter capital has this knowledge about how these companies work. We show them our numbers, we show them our models, we show them how we run a business. For them, it was probably like straightforward. And while with everyone else, it's sort of like a long journey of explaining what SaaS is, what, like subscription revenue is, what's like churn, what's like, like monthly recurring revenue. Lighter capital are experts at this. And that's why for us, it was absolutely a great option.
Got it. So your niche is contractors and lighter capitals, SaaS startup developers, essentially. You both have your niches. So obviously you discovered lighter capital. I'd love to understand how you discovered them, but I also was wondering how did you go about it? Because you said, okay, hey, we're ready to start exploring options. Did you just go to like a bunch of VC websites and start filling out like contact us forms? Like how did you even start to have those discussions with other people? Did they come to you?
Well, some people come to you because as you grow, they will see you on apps.com. For instance, they will see you on other like listings like Capterra, you will pop up here and there on LinkedIn, and then some people will reach out. However, if you're not looking for seed, you're looking for more like Series A, it will require some extra work, right? You're going to need the right connections. You're going to need to talk to people to give you sort of like a hot, sort of like, like give me like a warm intro for this VC, help me like get in touch with them. It's like a whole process. The reality is that we've wasted so much time there because even if we were actually, at the end actually of that process, we actually had the option to raise some VC money, but you know what, the terms and the whole like structure was not good for us as a company and not good for the way that we wanted to grow, which was sort of like, which makes sense. Some companies are like perfect fit for Series A, some other companies are not, and they have to find other like funding options.
Got it. So then how did you discover lighter capital? Just Google searching?
Actually through Intuit, because we got the announcement of like, hey, we just started a new fund, like a $50 million fund, and we didn't know about anything. That's the reality. It was sort of like, and for us it was like, wait a second. They have a fund for like Intuit developers. We've been with, like with Intuit for 3 years. I think we have a good relationship. We go to QuickBooks Connect every year. We have like, we know people in the ecosystem. We are like partners with T-Sheets, with ClockShark, with Fundbox. And it was like a no-brainer for us. And I'm glad that it was apparently also a no-brainer for them because the process was like ultra fast, which, when you are like a very small company I cannot like leave for like 3 weeks, you know, like in a roadshow in the West Coast to talk all this, to all these VCs. I need things to happen very fast. And with them, it was like extremely fast.
Got it. Cool. Hey, I think, Alan, you have a cool slide. It might be appropriate to show because like obviously Mark's talked about all these different paths he tried to go down, but I think you have a cool slide that captures like where you fit in the market between that Series A to Series C, you know, where you're fitting in with friends and family. Yeah, I think there was this one. I've seen it before.
Yeah, absolutely. I mean, the great thing about Lighter Capital's our model is that we're really agnostic to the cap table. And so in that, you know, traditionally, you know, I think it's 55% of our companies that we fund initially are bootstrapped. So maybe they've raised some friends and family, and now they want to add some, you know, more of a traditional capital source to the in terms of debt to the balance sheet to fuel the growth. But that being said, you know, we can help extend the runway, right? So Knowify is a perfect example of that, where they are eligible for equity financing, and obviously those investors are wanting to get help fuel the growth of their company, but also in exchange want to take a relatively large piece of it, right, in exchange for those dollars. So where Lighter Capital really fits in is in Knowify is a perfect example in that we can extend the runway to the point if they do want to go and raise that Series A. But in doing so, they've used our capital, which is non-dilutive. They've retained 100% of the percentage of the company that they have today, and allows them then the leverage of going out to spend the time finding the right partner if they do want to go to raise equity, as opposed to having to find the first check that they can, right? Because we can fund up to $2 million, so which should provide Knowify a pretty long, you know, horizon to continue to add fuel to the company, adding people, you know, more, whether it's product enhancement, whether it's the customer success team, salespeople, whatever it might be, allows them to continue to build the business without having to spend, you know, 9-12 months trying to find those equity partners. Does that help?
Yeah, definitely. Because what I like about this, it kind of gets it all in one easy picture, right? It's easy to see. Yeah. And I think, Mark, I think we were talking offline a little bit. You've done a startup before, and you went down the VC route. Like you've kind of taken this path once before in the past?
Yes, I mean, we had like a company called O-Golf in the past, which was helping like golf players. And that process was also interesting. I mean, like getting like, it's been also similar with Knowify. I mean, with Knowify it was different because our product was much more mature and we were like in a better market, like the whole conditions were better, but we did with O-Golf and it was very hard, you know, and I feel that I mean, obviously, I am very biased, right, after like this process. Obviously, we've got a very good time with Lighter Capital. We've got a very hard time with everyone else. You know, you have the perfect guest here. but the reality is that, I mean, everyone that is like in this chat, in this webinar today, I mean, think about this. Think about the growth that you think that the market can take, right? Not everyone can explode, you know, like not everyone can be Uber and just like try to, you know, like get the whole market and by like burning a ton of money. Other markets, other apps, they're like more niche, you know, like they have like a different like growth strategy and consider your options. I mean, consider like what the things that you hear out there, because you will find seed investors, you know, you will find like even like, you know, friends and family and like extended family. But there are all these other options like Lighter Capital that will actually help you. You know, they understand very well how the business works, and that's always very important. You know, when you partner with someone that understands the business, you will have a better time, because try to get money from your uncle, right? And then your uncle is gonna be calling you like every month. Hey, Mark, how are we doing? You know, when are we like having an exit here? Jesus, I mean, like I don't know. You know? So I mean, with Lighter Capital, they only invite me to go for dinner. You know, like that's actually great, and they pick up the check, so that's pretty good.
Oh, that's awesome. So how was retaining equity like a part of your decision, or because I know you've said definitely you need to be working on your company. You don't have time to take a tour on the West Coast for 4 months, meeting with VCs to get funding, right? You need to work on your product, right, and do development. So obviously, other things have to be important to you in those decisions. So where was retaining equity in your decision versus doing this VCs route?
I think there is a balance between the actual amount of capital that you need and the equity that you obviously, everyone wants to retain 100%, right? That's sort of like everyone is on the same page here. However, you might be willing to give up equity if the guys that you get will accelerate your growth in a way that compensates the dilution, right? If you don't feel that you are in that part of the equation, right? If you feel that they're going to give you, like, they're going to cut you a check for $2 million and you will not be able to put that money to work, you should not give up 30% of your company, right? So for us, it was kind of like both things, like we did not need that much funding, and we didn't want to dilute, our team.
Can I ask a question on that, David?
Yeah.
Mark, how, I mean, there's the value of that equity in terms of dollars, right? But then there's also the value of that equity in terms of control, right? So if you are going to go the equity route, as you continue to raise, then that dilution factor starts to take effect, right? What was the balance there for you in terms of wealth versus control, maintaining control of your company?
I mean, the control part, I didn't hit on that point, but the control part was especially important for us because we already had sort of like a strange cap table, and adding more complexity there would probably like put us in a very difficult position for the future if we ever want to raise more like institutional funding. And we had a couple of offers there that were also that would complicate even more the stuff. So for us, lighter capital, the fact that you will not be in the cap table,
right,
that was also like very important for us. I don't know if it's that important for everyone else, right? If you have like two, you are like two founders, and you just like got some money from your uncle, so you're like 3 people in the cap table plus a couple of employees. You add 1 VC or 2 VC or 3 VC, it's not the end of the world. But for us, we already had somehow like a complex structure, and we were definitely looking for something like cleaner.
Got it. I just lost my train of thought here.
David,
definitely.
Worth mentioning, we've been dancing around a lot around the comparison to equity, right? In terms of, obviously, if I had the opportunity, I was looking at term sheets to kind of balance the dilution factor, the control, and so forth. Another part probably worth mentioning from Lighter Capital's perspective, and Mark hit on it earlier, is like going to a bank, right, and trying to get funding. And the thing is that when there's these early stage SaaS companies, it's really difficult for traditional banks to get comfortable with those funding with the company because they're very asset light. You may be really capital efficient, but in a lot of cases you're still burning, right? You're not showing positive cash flow or income. So for your traditional banks, it's really difficult for them to get comfortable with it. So then it kind of opens up the other options around venture debt or tech banks, right? And it's probably worth mentioning, just kind of walking through this just so those on the line have to understand the landscape, right? From a tech bank perspective, they're typically looking for companies before they provide any type of debt. They want them to have raised a Series A, and a lot of times there's a certain threshold of investment that has been done, right? Before they'll start adding leverage to it. So while there's a lot of support for the early stage companies in the market, the actual providing of growth capital is relatively limited on the earlier stage. So that's why there's a lot of comparison to, like, people were talking about equity, because equity is the way for them to fuel their business unless they have that rich uncle that Mark referenced, right? Or those great friends and families. Venture debt is an option, but a lot of cases, you're going to see dilution in there. You're going to see covenants that it might be restrictive for the business. And so there are a couple of different options, but it really is a matter of like finding the right partner, growth capital partner that fits with your stage of business and also where you want to take it, right? So if you don't want to raise equity, then that's absolutely fine, right? It's finding that partner that can help you get to the next stage to where then you can take on, maybe it's a different form of institutional debt, right? But it's just really understanding the path of your business, knowing what you want to do and what partners make sense in that. So
yeah, I listened to an interview. I was on NPR, and I don't know which billion podcast I listened to, but it was the founder of Whole Foods. And he was talking about VCs and kind of that relationship. It's like, great. It's like you pick up a hitchhiker and he's got tons of credit cards for gas and you can go anywhere you want. And the second you turn maybe a direction he doesn't like, he pulls out a gun, holds it at your head, and he forces you to drive anywhere he wants from that point forward. And I think it's an important consideration of who you're partnering with. It's not just about getting the money, right? It's who you're partnering with.
Yeah, and this isn't, I don't want to be anti-equity here, right? There's institutional investors out, like equity investors, that are absolutely amazing. But what it comes down to is understanding what you want for your business, and are you willing to be in that situation, right? Because so many companies in this country have been built with equity investors, right? But not everybody's going to be the Facebooks or the Airbnbs or the DocuSigns or whatever it is, right? There's going to be people that build these amazing companies that they can go and sell for millions later and change their lives, but they didn't need to bring in that equity. So it was how I built this is what I think you're.
That's it. That was it. You got it. Good job. You have to listen to it as well. I think I want to open up to some of the attendees' questions, but I just had one more. I think you've mentioned it a little bit, Mark, but like as you grew and you had influxes of capital or money, like what did you use this on? I think you said, we attended some conferences. We did that specifically with the Letter Capital funds, but what about just other funding along the way and capital you've gained?
So things that we've done, obviously, like the most important part for us when we talk about funding is definitely like the team, right? And like having like new hires and like having new people on the team. So in the Untitled Capital case, we actually hire someone the very same week, that we got the funding. So for us, it was extremely important because we did need someone in customer support, sales, and it's usually for us, there are like, at least in Knowify, there are 3 ways where we spend money, right? We spend money with team, we spend money with, like growth initiatives, it would be like, digital campaigns, like all these AdWords, like Capterra and so on. And we also do like trade shows like QuickBooks Connect, or we do like more like industry specific trade shows. And obviously if you try to stay very lean, these shows can get expensive, and actually there is actually an amount of money that it goes out immediately. It will not return right away. You will not see immediate return. So we are sort of like building for the future. And for us, it was very important. And those are the things that we've been able to fund with Lighter Capital.
Got it. So Mark, this is a question for you, and it's totally related that came in. I think somebody's trying to maybe possibly understand the ratios, maybe of the way you have your company structured. So I'll just read the question. So Mark, who are the people in Knowify? So doing the math, you have 4 devs, you have 2 support people, 2 people in sales. Who's the 8th person you hired? They're trying to understand your structure here.
No, it makes sense. Because obviously we had to play we wear like multiple hats here. So we have 2 founders, Dan and I. And, I take, care of I am the CEO, and I take also care of the technical part, and Dan takes care of, like all these like growth initiatives that I would call it, like big clients or like big channels and so on, especially accountants, for instance. That for us is an extremely important channel. And then we have 3 devs, and the rest is actually customer support. Really, the funny thing about Knowify is that we don't have technically sales. I know that people buy Knowify, right? But they sort of like buy it organically. They reach out, they sign up via apps.com or like via our website. And then when they reach out, we help them get onboarded. But we don't actually have like a sales process. We don't go there and cold call people. We don't go there and do like the hard, sell. That's actually something that we don't do because, we like this sort of like, like simple approach. People get excited about us. We need them to get excited because these are very tricky industries, right? These guys, they have been using, like paper for like the last 3,000 years. So no, that's actually 100% true. So if you think about a construction job site, it looks literally the same, like 3,000 years ago and today. So these guys, they have to be convinced about changing before we get in touch with them. If we try to contact them and we try to, let me show you, like, let me educate you about how the construction industry should change. Maybe that's going to be a possibility in the future. For us right now, this is not an option. These guys are like, yeah, I know how this works. I've been doing it for like the last 30 years the same way. But I would like to change a little bit my business. Great. That's when we are actually like ready to help them. So that's why we have this like weird approach where we don't have salespeople.
Got it. But your service, ultimately, I've always said this, it's software as a service, right? So it kind of makes sense that you use the staff at your service or your service part of your business, the employees that provide that service. So Allen, what about you? Like when you, a lot of people that come to Lighter Capital to get funding, like what are they using it for? Is hiring engineering talent, service people? Is it all over the board? Like what are you kind of seeing?
Yeah, it's a good question. It's a lot. We want the money to be utilized for growth, right? So it's not coming to us and cleaning up a note that your uncle gave you, right? That was cash pay and so forth and so on. So it's really about, as Mark has done, right? Putting the money towards, getting more exposure at QuickBooks Connect, hiring that customer success person, right? To make sure that you can control churn, right? And so in a lot of cases, it might be hiring another dev for product enhancements. It might be hiring in a different model, unlike Knowify, where you actually need salespeople. You might build out an inside sales team. Depending upon where you're at in terms of your life cycle, right? As the company's getting bigger, we've seen often people bring in a VP of sales or something along those lines. It just depends upon kind of where the company is in life cycle. Important to note though, in that, and Mark can attest to this, when we provide the capital, we're not dictating where the money needs to go. Obviously, the entrepreneurs built their business to this point, and so where they feel best to put that money is important, right? And so it's not necessarily, we're not necessarily dictating where it needs to go, nor are we requesting proof that that's what's happened. So a little more like equity in that.
And then are you guys, Alan, at Letter, so if I need some special engineer to do something, like, are you helping talent matches, helping me track down talent, putting me connections to other resources I might need? Or are you just like, hey, you're going to do it on your own. Here's the funding. Like, where do you play that?
It's less, I mean, that looks a little more like equity, an equity investor and being that strategic advisor. We tend not to play roles in hiring.
Okay. Yeah. Got it. Some panel questions are coming in the Q&A panel. So reminder of the rest of you do have questions, please put them in the Q&A panel and I'll get those asked. One really funny one came in, if we have something against uncles. Apparently, we've been uncle bashing a little bit here. And then this one I think is really specifically to you, Alan. How does Lighter compare to MRR line of credit?
Yeah, it depends upon the institution. I mean, we're similar to it in that the MRR facilities are typically a multiple of the monthly revenue, right? And so we're not that far off, really. I mean, it depends upon who is the provider. I can't really compare specifics, but I'll talk about how we look at it. So we provide the amount of money that we fund is a multiple of your monthly revenue. So whether that's, sometimes we look at a 3-month or 6-month or what have you average. And so if you're doing $100,000 a month in revenue, we can lend anywhere from $300,000 to $400,000. We're repaid then over a 3 to 5 year period by way of a percentage of a royalty rate percentage of your monthly net cash receipts. So it works, they're relatively similar, but in some cases, some institutions, those MRR lines they have a longer term period, right? So they don't act like a true line of credit. Whereas, if you're comparing it against a true line of credit, those have to be typically cleaned up on an annual basis. So there's that obligation, that the larger cash outflow obligation to clean that up earlier.
We have a question about like your overall Later capital presentation or any more background. I think we'll send all of these out. I know Annie's listening in, just for confirmation on that. Annie, if you want to put in the chat, yes, we'll send those out. And then we also, I'll track down the YouTube video and try to get into the chat panel from we did this 2 weeks ago, 3 weeks ago, and I'll get that YouTube video linked out. So that way, if you guys want to watch that this weekend and get a little more background as well. Leading off of that, somebody wants to understand what the application process looks like, Alan.
I'll let Mark answer that. He's been through it.
Okay, good idea.
So it's actually, I mean, if you try, it's going to be similar to what you would do actually with a VC, right? So you get like a classic intro call, you talk to them, they see that you're real, and then you're going to have to submit, financials, business model, how you plan on spending the funds. They have a very nice intranet where you can actually do that. You can connect to QuickBooks Online if you use QuickBooks Online to run your business. So they connect to QuickBooks Online. They can grab your balance sheet and your income statement, I believe. And they also connect to Stripe. So if you use Stripe for like payment processing, they get all the information from there. They connect to your bank, and then they get also they can see all the transactions there. So you provide all this information and access to all these channels. You provide the cap table. You provide some information about your sales process, your marketing process, and it's actually very straightforward. I feel that we had 2 calls, and I did we submitted an online form, and that was pretty much it. I think they were faster than us at answering. Which was actually absolutely great. I mean, as I said before, given that they understand these metrics and they understand the growth and they understand the business, it's probably, I guess, very easy for them to make a decision.
Yeah, that's a fair point, Mark. I mean, we have a ton of technology behind our business, so it's really tech enabled, and so therefore the heavy lifting on the part of the entrepreneur is minimized, as well as on our end we can move very quickly. I mean, we funded deals in as little as 10 days, for new clients, and so it allows it takes takes away that 9 to 12 month process of trying to find capital. I'd say it's from the application process, building on what Mark was saying, it's very data driven, right? This isn't about trying to establish the TAM or the product market fit, or how do we get a 10x return on our investment, right? It's about understanding the business that has been built, kind of where it's going and how it will continue to grow, but then how do our funds help fuel that growth in the future? And to Mark's point, I mean, the QuickBooks integration makes it extremely easy as it relates to getting the information in and making a decision off of that.
And you made a comment that it's a very data-driven process, right? You're looking at the numbers, et cetera. Can you explain, because I think, if I remember correctly, that's kind of how your payment terms, like paying back this capital, right? It's also data-driven based on the numbers and the sales and things that are happening. Can you explain that a little bit?
Yeah, it's really simple. It's a matter of it's just a percentage of monthly net cash receipts. So, if initially we establish the amount that we can fund off of the last average of 3 to 6 month revenue, depending on what that looks like, right? So if it's, $100,000 average, we're going to do a 3-year facility. So we fund $300,000, right? Let's say though that let's say we use a 5% royalty, right, to get repaid based on the modeling of the growth of the business and the term and everything else. So let's say that, but the first time the payment is due, those monthly net cash receipts are actually $50,000, right? So that 5% royalty applied to that $50,000 in net cash receipts would be a $2,500 payment due to us. If it had actually been $100,000 in net cash receipts, then we would receive a $5,000 payment, right? So it ebbs and flows throughout the year. So it works well across all sectors and segments, but it's really, when you start thinking about just the kind of the nuances of it, when you start thinking about like a gov tech or an ed tech kind of business, right, where you have lumpy cycles of buying, it really allows you to not have to, you don't have to cover any debt service in those lower months, right?
Which is a cycle I think, that's a cycle I think we have, because you get a lot of people on the first of the year, especially in the US market, right? Hey, it's the new fiscal year. I'm going to switch to new systems. This is when, even QuickBooks itself, our sales explode and Intuit payroll explodes, but then you get this summer lull, right? Like August, nobody's doing anything. And so you're going to allow them, the developers, their payments will adjust accordingly.
Yeah, adjust accordingly, absolutely. Yeah.
Got it.
It's not a percentage like obviously cash accounting, there's no real different, but in terms of like the accrual accounting, right? If you get your annual prepaids and you're amortizing that over the course of the life of the next 12 months, right? That we aren't looking at that for our payments. We're actually looking at when the cash comes into the business, thus the net cash receipts is what we're paid off.
Got it. So then 3 months from now, when every contractor moves to the cloud, and will Mark just pay it off early? Like, how does that work?
Yeah, so that can happen, but the reality is that if Mark is continuing to grow the business, then he's going to need capital to continue to fuel that, whether it's hiring more devs or hiring more salespeople or hiring salespeople, right? And the infrastructure grows. So we, over time, as that revenue grows, can fund more money to the company. So we kind of think about it in tranches. So each kind of funding that we do can't exceed $500,000, but we can take a company, fund up to $2 million to an individual company. So, that provides a long runway, as I indicated. So, to your point about do we get repaid early, we mitigate that by way of we tier our royalties. So you may, like I mentioned before, you might have a 5% royalty on net cash receipts. But if the company feels like they're going to have a hyper growth scenario, we obviously don't want them to pay off early, right? So we structure it in a way where your first, say in this case, let's say you're doing $100,000 a month, right? So up to 1.2 million, you might pay 5%. If you eclipse the 1.2 million, you may drop. It may drop, depending upon the model, to 2.5% to 1%, whatever that looks like. So the idea is that the entrepreneur isn't paying us off prematurely.
Got it. Makes sense. A couple more questions came in. One was asking, is this only for U.S. companies? What are the regions you support?
Yeah, right now, but there's a U.S. based company or has a subsidiary in the U.S. So if most of we want to see, obviously, the way in which we get repaid is by way of of those net cash receipts running through U.S. bank accounts. And so as long as there's some presence here that we can get to, then we can It doesn't, the whole entire business doesn't have to be here. We've funded companies with, IP in India or other European countries. But at the end of the day, if the majority of it is here in the US, that's what we're looking for.
Okay, got it. There's another question coming about the cost of funding, like kind of what's the example interest rate?
Yeah, so we look at it from an IRR perspective, only because of the variable nature of that, or you can look at it from an IRR or from a repayment gap. So on an equity side, right, investors are, you're giving away 20-30% of your company in hopes that they will get a 7 to 10 times return on their money. If we're doing a 3-year facility, we're looking at anywhere called 1.35 to 5-ish in terms of the on that money. So if we fund $100,000 and it's a 1.35, we would get $135,000 back, of which $100,000 is the principal and $35,000 is interest over that 3-year period. Effective rate, I'd rather have a one-off discussion. I'm not trying to be, the range of like, it's different than a traditional bank facility where they say, well, it's prime plus 1, right? That's just not the way ours works. It's a risk-based model. And so we look at kind of what their growth is, what the size of the company is, what the churn looks like, what their runway is, and we run it through our model. And so I'd rather, if people have questions about it, we can provide a pretty quick indicative terms around what that would look like for them. So,
Got it. It sounds like I think Marc was saying before, because you guys do this with just companies like his and companies like all the attendees, right?
Yeah.
That even you can dig into some of the details on these things, and it's not like point teak. Like if I went to a traditional bank and he's like, "What's SaaS? What's cloud?" And yeah, you can have deeper conversations on the numbers.
Yeah, I mean, once we kind of get the financials loaded and some questions answered, we typically are pushing to turn around, indicative in terms within, call it 24 to 48 hours. So I don't know, Marc, how your experience in with that.
That's accurate. That's accurate. And I feel that about, like interest rate and ARR. I mean, the reality is that we look forward to seeing these like peanuts in the future. Like the reality is that we give you access to capital. We don't take ownership. You can hire people. You can run your initiatives right away. We will look back and look at this interest as, it was actually like cost of doing business, but actually like a great way of finding capital for us. And I feel that, rather than getting lost in the percentages and numbers, I feel that you have to look at the whole picture, right? And see, okay, what is lighter capital adding here? What is the value? And all these other things that we've been talking about today, that, waste of time, relationship with your investor or partner, and so on.
So this question, I think, could kind of apply to both of you a little bit. It's from Graham. If we are approved and everything works, and then we want to return to Letter Capital in the future to get more growth-oriented funding, what's the time frame to feed that growth in each investment round? Is it like, oh, I'm already there, so it's instantaneous, the very next decision? Or, do you like people to pause and wait a couple months? And then Marc, I think maybe your perspective of what's your plan is your next steps with that. I think it relates to both of you.
Sure. Marc, you want me to answer? You want to kind of go with more of the functional side of it? All right. Yeah, so the way in which we look at it, it's kind of, I break it into two kind of groups. So the one side of it is, if you come to us and the amount that we're providing you is kind of maxing out the capacity at that point in time, right? Now, there's the way in which we can provide additional capital is by the entrepreneur growing the revenue of that company. So obviously, using the scenario, again, the $100,000 a month of revenue, if we can do, 3-year facility, we can provide $300,000. If they can take that $100,000 that they took from us and hypothetically speaking, double the revenue, right? So you go from $100,000 to $200,000. Now we could provide $600,000 in funding, right? So it kind of walks along with the revenue growth, right? So in that case, typically on average, our follow-on rounds happen in our portfolios about 6 to 7 months after that initial funding. So, probably the reason for that is usually we're pushing entrepreneurs want as much money as they can get day one. And therefore by the time they start seeing the effects of the developer that they hired or the salespeople or the customer success, you kind of have that tail to grow the revenue. And so, but that being said, if they grow it quick enough, we're typically wanting to see 3 months kind of in between each funding. So if all of a sudden things light on fire and you've used that capital and you need more, I'd say 3 months is the window. On an outside scenario, kind of on the outside cases, sometimes we have companies that come and they're really large, right? And so day one, they qualify for, that we effectively could fund them $1 million on day one, right? That they look at, but we limit it to the $500,000. So typically, so, we may fund that 500 that in that first tranche, and they're saying, hey, I need the additional money in 2 months. Can we kind of work through that, right? So there's those one-off scenarios that we're always willing to kind of work through. But on average, I would say that again, typically 3 months is what we ask for in between fundings, because that allows us to see a little bit more performance from the initial funding date, as well as, like I said, on average, we're seeing about 6 to 7 months in between those funding rounds.
Got it. Yeah, that makes sense. So then, Mark, what's your roadmap? Like, what's next for you as far as, like, obviously you currently have your funding round with Lighter. Like, where are you at in that process for next one?
So as Allen already mentioned, I mean, the reality is that sometimes when you put this money to work, it takes some time to produce. And we plan on, we keep growing, and we plan on like seeing by the end of the year, we should have our burn rate, like very low, hopefully. As we approach that period, it's going to be again, okay, what do we do next? Right? We just stay like this, or we want to grow a little bit faster. And then probably it's going to be a time when we're going to talk again with Lighter Capital and see what we can do next.
Got it.
David, I think it's important to know too, like in terms of those additional funding rounds, right? That we can, because of Mark kind of alluded to before in terms of having the integration with QuickBooks, as well as kind of having visibility, read only into bank accounts or Stripe, right? That we know how the company is performing, right? So this isn't a situation where if you go to an equity investor, you have to go through the process again, or if you go to a bank, you got to re-educate them on it, right? And a lot of times we're actually going to the entrepreneurs and saying, hey, just so you know, we can provide you another 150 or 200 or whatever the number is, right? That if you're ready for it, it's here for you. So just let us know, right? Okay. And that process actually takes 3 to 7 days. Like if they're ready to take it, it's a simple amendment to the existing agreement, and we can put the money out the door. So again, to Mark's point, earlier about the value of that time, it starts to compound as the relationship develops.
Got it. Perfect. So just another question kind of flew in here. Just to confirm, is this a recourse loan? ?
There's not, if by recourse we're talking about personal guarantees, no. We do have a lien. We aren't unsecured. We do have we file a UCC on the company, so it gives us a little bit of protection. But as you know, if a company is going down, there really isn't much. There's not much there for us to go to. So kind of the delineation there.
Got it. But I mean, if ultimately, like you said, you're watching the data. Right. So you're going to be in theory, you should be surprised by this, but you should be you're going to be on top of it to some extent. You're going to see where the sales are, et cetera.
Yeah, we're not surprised. Again, the technology between the visibility that we have into the companies, coupled with our technology monitoring the companies, in addition to the SaaS model, you're not going to see a company fall off a cliff. Right. What we see is kind of that sunset, right, where maybe churn is increasing and you're starting to see some loss in clients. But, and it's really kind of, that's when the discussions begin around what's happening. Can we help in any way? Right. What do we need to modify the facility, or what's going on here so that the entrepreneur can work through whatever it might be in terms of a rough patch? They might be pivoting, right? They may have been like, we had a product, we've now launched something new. So we're going from SMB to enterprise. And so there's just a little bit of the transition state there, right? Where the company's catching their traction on the enterprise side of things. And so it's just those discussions around how do we help you through that? So, but rarely is it going to be that we get a call and say, we're done, the business is closing.
Got it. Questions have kind of dried up. I've dried up. Is there any, if somebody's interested in Lighter Capital, what's the best way for them to get a hold of you, Allen?
Yep. Yeah, we'll send out the information. You can reach out to myself. You can reach out to Tom Malcolm, who heads up our partnerships with Intuit. I think if we send out all the contact information should be on that. Annie can probably circulate that as well following the call.
Got it. And then Mark, if anybody any developers want to ping you and just like pick your mind, like, hey, how did this go? They want to, you know, get a little bit more one-on-one validation on this. Is it okay for them to reach out to you?
Yeah, sure. I would love to talk to them.
And just Mark at Knowify, like, how do they get a hold of you?
I'll give you. I'll
put it in the chat. Okay.
Yeah.
Perfect. Hopefully everybody sees that in the chat there. Again, Alan, Mark, thank you so much. This is great. I thought it went pretty smooth. It was great to understand a little bit more of the developer's point of view on this, right, and what their experience was. I really enjoyed it. Hopefully everybody that's attended has enjoyed it. Any other closing thoughts, Mark?
Just that, I mean, I think that the webinar has been great. I mean, I didn't have that many questions from my end. I wanted to ask a little bit about Lighter Capital and how they got started, because that's something that I never asked. And what was like, what was the origin?
Yeah, that'd be great, Alan.
Yeah, sure. Our founding member, founding entrepreneur was an individual named Andy Sack. He was a serial entrepreneur here in Seattle. Was involved with Techstars, Techstars Seattle. I was helping a lot of companies kind of get going, and the experience of having people come to them constantly. The equity investors say, who are your top 2 out of the 20, right? Of like, who should we talk to provide capital to? He just realized there had to be a different way to do this and provide early stage capital to companies where it didn't require them to dilute or be that perfect fit for equity investors, right? Because as you may or may not know, that there's Harvard Business Review did a study, and effectively only 1% of companies get VC funded. So it's such a small percentage that where's the other 99, right? Where are they getting funded? And so that's kind of was the start of it, and started thinking about different models, and they kind of came up, revenue-based financing has been leveraged, utilized in oil and gas as well as in the movies and media industries. And so they looking at that and saying, hey, there's got to be something here as it relates to kind of the tech space. So, and with that, they got some capital, and then the rest is history. So here we are. We've funded. We're north of $100 million funded to over 250 companies and deployed nearly 425 rounds of funding. So it's obviously working, and so we're excited to be. And obviously the Intuit Fund is a big, was a big thing for us. We love it. The ecosystem itself is just perfect for lighter capital, and obviously, as Mark, as you've said, not everybody's going to be that unicorn. So how do you provide capital? How do you get that funding?
Awesome. On that note, I think we'll shut this down, and we'll see you guys in a bit. See you at QuickBooks Connect, right?
Thanks, Mark. Yeah, we'll see you. All right,
bye, everybody.
Bye.
That's it.